Welcome to all of you, wherever you are. I'm Barry Brooksby, founder of Focus Wealth Group, and tonight we're going to learn a lot more about real estate. And these numbers that I'm going to share with you, in my opinion, they're mind-blowing. I was prepping for the webinar just a couple days ago, looking at the numbers and thinking again, wow, it's mind-blowing. I'm super excited for you to see what's in store. By you being here, it shows that you have a desire to learn, and that is so important. You're investing in yourself, which is fantastic. You'll learn things tonight that are unknown to most people. Now, whether you're already a real estate investor or you want to become a real estate investor, either way, you'll get a ton of valuable information out of the webinars. And I promise this will be eye-opening and powerful. So take notes, dive in. I'm 14 years in the real estate industry, and I've got clients all over the country with my financial company. I'm 18 years in financial services. I've owned and been a part of multi-million-dollar companies. And tonight, because we're talking about real estate, infinite banking, and cash value insurance and how that can enhance that, I have been in the real estate world. I've owned single-family properties. I've owned land. I've done flips. I've had rental property. But it's one of those things that there's a lot to learn, and it comes with some risk. But I really love real estate when it's done correctly. Let's learn how to boost your real estate income using cash value insurance in ways you've never seen. Answer this. Can your dollars do more than one thing at the same time? This is the question that I want you to be thinking about throughout the webinar tonight. Now, because I love music and love to play the guitar, I'm going to use a music analogy. This is Gladson Peter. He can play over 40 instruments and can play 22 of them at the same time. And you notice here, I'm going to use my arrow. He's got the guitar, obviously, and a ukulele. He's got a keyboard down here. And look at these ropes or strings tied to the drums. He's got the kick drum, the bass drum, you might call it, the hi-hat with the stick up here, the snare drum back here. And look, he's even got a little one of those whistles and a harmonica sitting here. Well, he's playing music. He's a one-man band, and he's doing multiple things at the same time. That's the question I want you to be thinking about. Can your dollars do more than one thing at the same time? He's able to do more than one thing at the same time, play all these instruments. He walks and his arms are moving. Everything is together, but he's doing more than one thing at the same time. I want you to think about this savings account, and there's $250,000 in this savings account. And in this particular savings account, it is a life insurance policy. It's a cash value life insurance policy. And this $250,000 sitting in cash value, it's your money, it's liquid. You have access to it anytime you want. And you decide that you're going to take a loan. And in this case, we're going to take a $200,000 loan. And we'll talk about what we do with that loan here in a few minutes. But the idea of your dollars doing more than one thing at the same time is this. When you take a policy loan from your cash value policy, that money is not physically removed from the cash value. There's a lien that's put against it. And so what that means is, although you have a $200,000 loan, this cash value is still earning interest. It is still working for you, even though you have a loan. Now, if you looked at any other type of investment, pulling money from a 401k or taking money out of a savings account, what happens? You end up breaking the compound growth curve, and then you have to start over again. But in a life insurance policy, that isn't the case. Your money is still working for you at the same time. That's the concept that I want you to think about right now, is that your dollars are doing more than one thing at the same time. You can go buy the real estate, or you can buy the car, or you can invest in your own business. And all the while, your full $250,000 of cash value is still working for you. It's incredible. We have a name for this. We call it the velocity of money, that your dollars are accelerating. They are doing multiple things at the same time. This is the efficiency of cash value insurance. I'm not going to dive into all the benefits, but here are just a few. 1, money's guaranteed to grow. 2, when you borrow the money, like I just mentioned, in the form of a loan, that money still works for you, not against you. You can leverage your dollars. I've used this example before. If you own a business and you're buying equipment or investing in your business, you might be leasing equipment or taking loans from banks. Well, imagine being your own bank and leveraging your own dollars to invest in your own business. We use that strategy quite often. This money is able to be used tax-free. You can use the cash value and the death benefit as collateral. And yes, there is a death benefit, so it protects family, it protects human life value. And the list goes on and on. So this gives you an idea as to what's happening with the velocity of money in a cash value insurance policy. Cash value insurance is an asset that never stops growing, ever. Now, when you start taking income out in retirement, obviously you're depleting some of the cash value, but you're still earning dividends. You're still making money. It's still growing. And it's this idea that I want to apply to real estate and the income from real estate and how to make more money in real estate. And in Robert Kiyosaki's book, Rich Dad, Poor Dad, he talks about investing in assets. Cash value insurance is an asset. Your business is an asset. Real estate, if done correctly, is an asset. You are an asset. Invest in yourself, right? All these ways to invest in assets. And what Robert talks about is that the number one rule of real estate or investing should be cash flow. We want cash flow. So let's see how this works. Let's see where this takes us. We're going to make a comparison here. These are the numbers that I was talking about earlier that have been so powerful to me. It's so compelling. And so on the left, the comparison is going to be what would happen if you bought a home or a rental property or a condo or a duplex, whatever it might be. You buy some real estate and you're going to pay cash out of your own pocket for that investment versus taking a policy loan from your life insurance cash value. I'm going to come back to this in a second. I'm going to pull up an illustration that I ran for Mr. Hugh Jackman. Let's make an assumption that Hugh Jackman purchased this life insurance policy 15 years ago at the age of 34. Well, in this example, we're just showing $24,000 a year going into a policy or $2,000 a month. And for the details of this, if you really want to learn this a little bit more, you can reach out to me and schedule a call. But the idea in this policy is that Hugh has this cash value growing every year. And so we're looking at this column right here called total net cash value. This is his money. This is what's liquid to him to be able to use for all of those ways to take loans that I talked about. In year 8, there's $200,000 here. Now, if he was setting aside $2,000 a month into savings account or $2,000 a month into a life insurance policy, the savings account earning basically 0% interest, the life insurance policy is going to outperform that. There's guaranteed returns here plus a dividend that's earned. So in this year, the 8th year, there's $200,000 of cash value. Now, instead of coming in with cash out of pocket, we're going to show this policy loan here in a minute using that cash value. So here's the breakdown. The purchase price on this property is $200,000. we're going to make an assumption that the property will be held for 20 years. And then at the end of 20 years, you sell the property. Some people have a 5-year exit strategy. Some people say, I'm never going to sell. And here's a little tidbit for you. If that's you, if you own real estate and in your mind, you're saying, I'm never going to sell, and you're going to pass real estate on to your heirs, it's awesome. The way the tax code reads today, when you pass away, if you own real estate and you pass that real estate on to your heirs, there's what's called a step up in basis, meaning all the equity in that property, there's no tax that's paid on it. So if you bought the property for $200,000 and you hold it for a lifetime for 40, 50, 60 years, and now that property is worth, let's say, $800,000, there's $600,000 worth of growth. Well, when you pass away and you pass that on to your heirs now get a step up in basis, meaning the property is worth $800,000. They don't pay a dime of tax on that $600,000 worth of growth. So it's a great strategy. It's not for everyone, but little tidbit for you. And if that's something you're thinking about, it works really well, at least based on today's tax code. So this $200,000 property is going to rent for $2,000 a month. Now, to be fair, I'm not taking out taxes, maintenance, HOA. I'm not doing any of that. Okay, I want to keep this really simple, but it will be fair for both sides because I'm using the exact same numbers. But I'm not going to get into the detail with depreciation and all the other things that come with owning real estate. So the first thing that we want to do is we want to look at what is this property going to increase to as far as value. The calculator I'm grabbing is called the future value calculator, because what's going to happen with the $200,000 property that we buy 20 years from now? It's going to be worth more money. And so we're going to call this market value. We want to look at what will the property be worth in 20 years. So we take our present value of 200,000. We show 20 years, and I'm just going to use a conservative 3% rate. We have 361,222 is what this property will grow to in 20 years. 222. The other thing we want to look at now is the cash flow. What's actually happening with this $2,000 a month, right? And because you came in and you paid cash with this property, it was 100% out-of-pocket cash, 200 grand. This full $2,000 is going to come to you. So we look at this other calculation. We take $2,000 times 12, $24,000 of income per year, and we times that by 20 years. So the cash flow that we've received off of the property is $480,000. Again, I'm not taking out taxes and maintenance costs. This is a gross number. And then we have to also figure in that we purchased the property for $200,000. So let's see what our end number is going to be. We'll take the 361,222 plus the 480,000 in cash flow from our rents, and we minus the 200,000 that we put into it. And so this property over a 20-year time frame is going to give us $641,222. Looks great, right? It's like, wow, my $200,000 earned me $641,000 over a 20-year time frame. It's great. Let's make the comparison now. And this is where the numbers, in my opinion, start getting mind-blowing. This is so cool to see. How we use a cash value insurance policy to make more money in real estate. So first off, the market value whether you're paying cash or using a policy loan or even bank money for that matter, doesn't change. This is the same $361,222. Well, now we come into a little bit of a quandary, and here's why. Our cash flow is going to be diminished. Why? Because we took a policy loan. And when we take a policy loan, we want to be an honest banker and we want to pay the loan back, at least through our working years. Now, to be clear, when you take a policy loan, the life insurance company does not require you to pay the loan back. So if you never paid the loan back, what they would do is they would subtract the loan balance plus any interest accrued from the death benefit when you pass away. But today we're talking about during your working years. So as you're working, be an honest banker and pay the loans back. What we look at then is a loan amortization. We put in our loan balance of $200,000. This is what we borrow. The life insurance company charges us anywhere between 4.4% and 5.5%. These are the companies that I use. There are other companies that charge higher, 8, 9, 10%. I only work with mutual life insurance companies that I have vetted, that are in front of the pack, A-rated. They've all been in business over 100 years. So I'm going to use 5% interest. And we're going to show this amortization over the same 20-year time frame, so that by the time we sell the home, it's paid for, right? We get our money back because we've paid the loan off. Well, the quandary is this. We now have a loan payment. We've got to make this mortgage payment back to our policy. And I call it a mortgage because it's a home, but essentially it's your personal policy loan, but you want to be an honest banker and you want to pay it back. That's the idea. And if we put in this 20-year time frame, 240 months, there we go. Every time that you make this, let's just call it $1,320, so this $1,320 payment, every time you make that payment back, what's happening? Well, the loan balance is going down. There's a portion of the $1,320 that goes toward the interest cost. And yes, that money is going to the life insurance company, but you are still earning interest in your policy. Remember the compound curve that I drew for you earlier. Well, what's happening is every month that you make a payment back and that loan balance is going down, look, the loan interest charge is getting lower, but the amount going to principal is getting higher. We like that. We want more of our payment going toward principal. So we're going to use this $1,320 as the payment to pay back our loan. So we take this $2,000 and we have to minus the $1,320. This is our mortgage payment. It's really a policy loan, but we're going to call it a mortgage because of the home. And that leaves us cash flow of $680 a month. Well, let's do the math. 680 times 12 gives us $8,100 a year over the 20-year time frame. So our cash flow, because we've used our policy loan, is only $163,200, not the $480 that we were getting before by coming in with cash. Now, most people would look at this right here and stop. Be like, yep, Barry, look, why would I ever use a life insurance policy to go buy real estate? My cash flow has greatly suffered. I now have a loan. I've got debt. I don't want that. Yeah, it looks that way. But we're not done. We're only halfway through the policy loan scenario. What we have to remember is what I drew out for you originally. This. that cash value life insurance, when you take a policy loan, that full cash value is still working for you. You're still earning interest and dividends. And because you're still earning interest and dividends, you don't lose out on the opportunity cost of that 200 grand. See, when I drew this arrow going down and you had to start over again, if you took money out of a savings account or a 401k or any other type of investment, you're dealing with lost opportunity cost. If you go pay cash for a new car, that money is gone. You cannot use that cash for anything else because you've dumped it into the car. And what if the next day your good friend says, hey, listen, I've got a fantastic deal. We're collateralized really well. We're going to earn double-digit returns. You need to come in with 50 grand. And you go, oh my gosh, I've been saving my 50 grand for the last 3 years. And I just bought this new car. I can't do it, right? That's a lost opportunity cost. But with a cash value insurance policy, you avoid that. There is no lost opportunity cost. So now we look at that in the equation. Here's what happens. The cash value of the policy is still earning 5% interest. So I'm going to pull up another future value calculator. So our 200 grand, although we took a loan, that money was not physically removed from our policy. It's still earning 5% interest. And look what that grows to. It never left the policy. So the 200,000 now grows to $530,000. $530,660. 361,222 on our market value. Although our cash flow is lower at 163,200, we now pull back in that we were still making money in the policy, $530,660. We minus the 200 that we put into the home. Boom. 855,000 is our net number because we used a life insurance policy. Our dollars were doing more than one thing at the same time. This is the velocity of money. And by using the policy, what happened? Well, if we look at the two sides, the 855 minus the 641,222, you come out ahead a positive $213,860. Boom. How about that? This is the power of a cash value insurance policy. Why doesn't the world know about this? That's for another conversation. The point is, these policies are so powerful because of the velocity of money, and you don't have lost opportunity cost. This is one example. Imagine doing this multiple times with multiple real estate investments. Imagine doing this in your own business. So there are a lot of different uses for this particular situation. It's awesome. The power here is so compelling. And the idea is, when you structure these policies specifically for you, we set them up based on your current situation. So although I show you the Hugh Jackman example at $2,000 a month, you might look at this and say, you know what? I can do 10 times that amount. Or you might look at this and say, I can only do half of that amount. The point is, start now, because we take advantage of the time value of money. And as you look here at the cash value growth, this cash value, it grows every single year. Remember I said earlier, cash value insurance is an asset that never stops growing. It grows and grows and grows. So the design here based on $2,000 a month, I only ran that for a 20-year time frame. And at the end of this 20-year time frame, I showed that the premium would drop to $6,000 a year. And there's a myth out there about cash value insurance. And that myth is, hey, once you lock in a premium at $24,000 a year, you've got to pay that the rest of your life. And that just simply is not true. There's flexibility. At any given year, this policy could be reduced to $6,000 or $500 a month. But there is flexibility here. Well, check this out. Because of the guaranteed growth, and you never lose money because it's not tied to the market, if you drop to the $6,000 here at the age of 55 or in the 21st year, the cash value in that particular year is $744,000. Well, the next year, another $6,000 goes in, but what did the cash value do? It grew to $784,000. On a $6,000 premium, the cash value grew $40,000. What 55-year-old out there do you know that sets aside $6,000 and sees a $40,000 increase on that money? And not only that, there's protection here with a death benefit. Fantastic design, fantastic use of cash. The idea tonight was how to boost real estate income using cash value insurance. And the power to be able to do that, I hope, has been very clear tonight as you see these numbers. You know, the argument that I've heard, to be fair, is someone will say, well, it's going to take me a long time, maybe, to build up $200,000 in my policy. Well, my argument is, yeah, but if you're going to do the same thing with cash, doesn't it take you the same amount of time to build up your cash? Right? So either way, you have to set the money aside. The choice then, are you going to set the money aside in a savings account that you know is going, the money's going to be there, but it's earning zero interest? You could put it in the market, but there's volatility, there's fees, just some trouble there. But with the cash value insurance, as you're setting that money aside, it is guaranteed to grow every year. I've had some clients do lump sums. They'll put in a lump sum of money one time and forget about it and let that grow. I have other clients that will put in monthly amounts and do a lump sum. I have other clients that say, look, Barry, I only want to fund a policy for the next 10 years and then I'm done. I want to be out, no more. Every one of those situations are an option. You just simply find what's the best for you. Hopefully tonight, looking at this with a real estate deal, you can see the compelling evidence, the numbers that are real, and it works. So as you think about your future, whether you're a real estate investor now or you want to be down the road, one of the most powerful tools that you can use in your portfolio is cash value insurance. It will make your real estate more valuable. Thank you for investing in yourself tonight with your time. Now, my challenge to you is to go do something about it. Take action. If that means setting up a policy, if that means start looking at real estate deals and talking to a local real estate agent or a real estate attorney, whatever that means to you, take action. Maybe it means investing in your own business. Maybe you're not interested in real estate. Maybe you just want to buy a car or you're looking at your own personal home. I don't recommend that you go buy real estate 100% out of pocket with cash or 100% with a policy loan. I'm showing you tonight the comparison of the two, how it works. Ideally, you would want to buy real estate and use your policy's cash value as a down payment. So in this case, if you borrowed money from the bank at $200,000 and they ask you to come in with 20% down, you would only take a loan from your policy of $40,000. Thanks again for being a part of the webinar this evening, and we'll see you on next month's webinar.